Welcome to Theo Trade. This is Don Kaufman. June 12th, 2020. Minutes left inside of the trading week. And here we are doing the weekend update. Feeling the wrath of volatility. One of the first points we're going to make, outlier events. They're all over the place. I'm going to detail here momentarily precisely what that kind of means. And really what it means, more importantly, moving forward. Let's get to work on this weekend's update. There is a tremendous amount for us to review inside of the next 20 minutes. So here we are. We're wrapping up the week. The S&P is having a little bit of a bounce to the upside, but you just can't read into it after what? 6-7% sell-off? Even worse if you're looking inside of the Russell on Thursday. Before we get there, though, again, I want to talk about these outlier events. And when I start to reference outlier events, we're actually going to cruise over to none other than the SPX, the mother of all products. So what do we mean by the SPX? Okay, and these outliers. All right, let's, as I said, kind of get to work over here. We're talking about outlier events. What I'm referencing in this particular case has to do with everything involving expected move. So on a week-to-week basis, and I'll just give you a quick example. The previous week, right here, we were looking for a $78 move, a $78 move higher or a $78 move effectively lower. Actual move way outside what was expected. The week prior to that, I'm just making a quick point with this, the week prior to that, we saw a breach of expected move. Obviously last week, okay, a substantial breach of expected move to the upside. And here we are, yet again, a massive breach of expected move now to the downside. The point that I'm trying to make with this, with outlier events, first of all, these outliers have made phenomenal trading candidates. If you've missed any of the trades that we've done, we've talked just incessantly about back spreads, okay? We talked about actually buying option premium. Specifically, I have bought iron condors, and made quite a bit of money on those. Again, alongside some of the back spreads. But again, to kind of detail a little bit about what I term these outlier events, the point that I want to make is that the marketplace seems to be going through incredibly long periods, if you will, of efficiency. This is a period of efficiency where just week after week after week after week after week after week, I mean, there's one little breach maybe right there, but almost every week in this time frame here was inside the expected move. I mean, again, there was nothing going on in the marketplace. The marketplace kept, creeping to the upside. And then we started to have breaches. And I'm actually going to zoom in on this so you can see it just a bit over here. We started to get some mild breaches of expected move. This one's to the upside. Here's a week to the downside. Here's a week to the downside. Here's a week to the upside. That's another week to the upside, another week to the downside. Then out of nowhere, an absolute massive breach, okay, of expected move. And the marketplace just got hideously then inefficient. And I say inefficient, that just basically means the marketplace is getting it wrong. How could the marketplace get it wrong? Listen, when I say that a marketplace is expecting a $78 move, and I just want to throw this up here for argument's sake. So we're expecting the $78 move, and that obviously would pertain to last week or even the week that we just passed through. It's about a $78 move. Okay, we go higher or lower by 78 bucks. If the marketplace exceeds that, like this week, what are we on? Okay, close to about a $160, $170 move. You see a $160 or $170 move, we're expecting a $78 move. Your two standard deviations, you get it? That's completely inefficient. The marketplace is getting it wrong. And by the marketplace, the options marketplace simply got it hideously wrong. You could have bought premium and made, okay, a ton of money. The point that I'm trying to make is we keep seeing this again and again. And I just want to point this out. Yeah, the market got a little bit efficient here and here and here and here and here. Okay, but lo and behold, just a few weeks ago, we cracked to the upside mildly. Last week, we cracked to the upside in a big way. And we talked about this on the weekend update. We said, listen, the marketplace just cracked the expected move 2 weeks in a row. Things might get just outright wild. And here we are, back to a heavy volatility situation. And I'm going to further this in just a moment. It wasn't just the cracks of expected move. We saw other indicators of risk coming into the marketplace. But when I talk about the expected move, it's just not fair just to throw the SPX in the ring over here, take a look at a product like the XLF. Now, the XLF, you're like, well, that doesn't have expected moves. Well, I'm going to click auto expected moves. How's that for a breach? I mean, we're talking absolutely massive breaches of expected move. Think about how many weeks in a row can the marketplace get it this wrong. Look at that. Huge breach to the upside, okay? Massive, just massive breach to the upside here. And of course, this week, I mean, we're talking 2 and 3 standard deviation type moves. Again, could have been blind throwing, money at the marketplace as long as you were on the buy side, okay? You made money at it. And that's one of the points, again, of why I'm using things like ratio back spreads. And I continually will stress that. In fact, we even talked about it on last weekend's update, okay, and throughout the course of the week, the 2650 level. Above it, hugely bullish marketplace. Below it, things were going to get downright hideous again. And that's precisely what we saw inside of trade. By the way, I don't want to just throw the XLF up here. When I say outliers leading to more outliers, okay, again, what that references is you had a couple of outlier events to the upside. Now you're getting an outlier event to the downside. Okay, where else did we see it? We saw it inside of the XLE, the energy sector. The energy sector got downright hideous as well. Okay, here's a point, though, to be made. I'm going to bring this up a little bit later as well. Okay, but if you took a look at the NASDAQ, the QQQ, this one's interesting, and I'll tell you why it's so interesting. The NASDAQ has not had nearly the outlier events. Look at this, okay? Pretty much closed on the edge of the expected move. This week, we're actually closing inside the expected move, inside the expected move, inside the expected move. Again, inside the expected move. And I'm telling you right now, okay, before I go any further, the NASDAQ is going to be in our crosshairs, okay, in, again, the coming week. The NASDAQ is absolutely going to be in the crosshairs because the product is actually displaying such incredible efficiency. We actually believe that it's the product that's going to crack apart, of course, next. Think about that for a second, because again, that is a huge portion of my trading methodology that I'm setting up for, okay, in the coming week and literally like the entire next month. All right. The next thing I want to display to you here. So we're talking about outliers leading to more outlier events. And I showed like the XLF cracked outside, right? Then you had the QQQ, which is actually inside the expected move. You had the energy sector well outside. I took a look at a lot of different sectors here. We looked at something like healthcare. Healthcare, that's just outright hideous in here. All right. So what was important, though, and the takeaway that was so important is that the NASDAQ, for the most part, again, it kind of held it together. Again, remember that because it's going to come up here in a few minutes. Okay, the next point I want to actually make has everything to do, okay, with weekly percentage moves. And we're talking about outlier events. I think it's only fair to discuss outlier events, okay, in terms of percentages. All I did is set up a chart. If you've never seen this before, I just set up the chart this particular week. So that's the week at large. There's 1, 2, 3, 4, 5 trading days. The financials this week closed down roughly 11%, right? It's fairly hideous. Okay, what's important about this, you're like, okay, so it's 11%. Who cares? Yeah, I want you to compare that. There's the closing bell. It is over. What I want to point out, though, isn't just the financials. I want you to compare that to other sectors. Like a moment ago, I was pulling up healthcare. Healthcare will close the week down somewhat, 6%. Then we're actually going to pull up the energy sector. The energy sector ends up, okay, down 15% on the week. But then let's switch gears a little bit. You can come over to the QQQ. The QQQ down what? Nominal. 2%. 2% on the week. What else you got? Let's actually pull up specifically technology like the XLK. The XLK, which is a technology ETF, down again about 2.5%. What else you got? We could look at things like XLY, which is consumer discretionary, down about 6%. Wait, we're going somewhere. XLP, which is the consumer what? Okay, consumer staples, down about 5%. Now, this is important because we're going to be looking at XLP quite extensively as well. Some of your consumer staple stocks are not necessarily holding up. Now, all I wanted to cover in here, okay, is just a handful of major sectors. And the reason that I'm displaying it in this particular fashion is I've talked just at huge extent about sector rotations. And what I want you to get a feel for is why I go after certain sectors. Why I'm in here talking about, like I don't like technology right now. If the marketplace is going down, okay, they're going to jump on the back of technology. It is what it is. They're going to jump on the back of technology. And I'm going to detail that here momentarily. It's why I wanted to show you some of the percentage gainers, the percentage losers. There really wasn't too many gainers, were there? All right, onward and upward there from outliers, okay, to weekly percentage moves. Now we're going to talk just briefly about the SPX because I've already kind of displayed it a little bit. So the SPX cracks way outside of the expected move. Now, for those of you that were kind of tuned into this from last week, we were looking this week for a $78 move higher, a $78 move lower. Ironically, the previous week was also a $78 move higher, a $78 move lower. And one of the things I said actually in last weekend's video, I was like, I was rather surprised. We cracked a $78 move, and yet they made the next week $78. They didn't raise up the volatility at all. So here we were again sitting on a $78 move. And roughly speaking, where did the week begin? Where did the week end? I want to show you something that's, again, I find kind of entertaining. But if I cruise over here to the Analyze tab, okay? So I'm in the Analyze tab, and I've backed up the date, right, to June 7th. And I want to show you. June 7th is Sunday. So what you're basically looking at then is you're looking at the marketplace, okay, from the Sunday perspective. And you can see there's a $78 expected move, right? But the market was roughly at what? 31.93. So the market then today closes at 30.41. Just bear with me here for a second. Do some rough and dirty math on this, right? So 31.93, okay? That's where the market closed last week. Subtract from 30, basically 41, equals 152. What is incredible about the 152? So we moved down about 152, okay, SPX points on the week. What's incredible about it is that there still is a degree of efficiency in this. We happen to move almost precisely, okay, to the 2 deviation move, just 78 times 2. What 78 times 2 is roughly what, 156? Instead, we moved to 152. And this is predominantly, and you're like, that's just, happenstance, that just kind of happened. It's not. It's how algorithms actually manage risk. So for the most part, we moved almost precisely 2 standard deviations outside. All right, enough of that. Now, okay, what I do want to point out, all right, you get it. We went from an efficient marketplace once again into an inefficient marketplace. But now what's happened? The crack to the downside, spiked volatility. Now, the volatilities, okay, are not yet set. That number of 124, that is that's a rough and dirty expected move. And I say it's not set yet because technically these options, they're still open. They're open for a few more minutes. I have the screen frozen, but if you take a look, you'll still see these prices updating. We should be right around $124 expected move. Interesting. Why is it interesting? Because we already moved over $150+ in the SPX, and yet we're making the expected move for an entire week 124. Once again, all right, you better prepare yourself for some volatility. Okay. As I was saying about efficiency and inefficiency a moment ago, I was like, listen, it cracked here. There's a pretty good chance we're going to be in Mr. Toad's wild ride. On top of that, okay, and I said this time and again on the weekend video, that's from last weekend, okay, we said it on Monday, we said it on Wednesday, the VVIX was the preeminent indicator here. Yeah, we warned you. We literally said the VVIX cracked once again above 110. And I'll just kind of display the last couple of trading sessions in here. Here's 1, 2, 3, 4, 5. And of course, last week, it actually cracked back into the 110 range. Okay, spliced into it this week, and we took off to the upside. You have to now realize and continue to recognize, first of all, the VVIX, it closed up today. It closed up with the marketplace up. That doesn't exactly leave me warm and fuzzy. The VVIX is back to the 150 level. It's duck and cover. It means get under your desk, rock back and forth until it's all over. This is serious. It is a very serious implication of risk. And it's not an implication of risk, okay, right here like tomorrow. It's an implication of risk now literally for weeks, possibly months into the future. When you start getting north of 110, again, everything changes because that's trading firms that are literally trading firms. You have to think about this. They're buying volatility today after the crap that we saw yesterday. And the market moves down 6-7%, and traders are buying volatility. Is that what you're telling me? It's exactly what I'm telling you. And the other irony of that, the VIX closed down today on a percentage basis by almost 12%. Yet there were net buyers of calls today. Okay, it's not even close. We traded almost 3 times, okay, the running average of VIX options today. That's Sizzle Index. That's 3 times, okay, the norm versus the previous 5 days, right? So for the most part, traders are buying volatility. Again, it doesn't exactly give me a warm and fuzzy feeling. And when I'm sitting here and I'm telling you, we warned you that this thing could get serious in a hurry. Now I'm warning you, okay, even more to the future. I think you'll listen now. And I say that, and I don't say it facetiously, because a lot of people are like, yeah. Listen, the VVIX, okay, cracking over 110, coupled with the fact that the expected moves were starting to show inefficiency, okay? Then we also threw bonds in there, which is exactly my next point, okay? The bonds all of a sudden started coming back to life, and when they came back to life, we said, like, this is it. This is the marketplace, and the marketplace is about to move, okay? The other interesting thing that a lot of people tended to, just kind of let go by the wayside, they weren't watching bonds. You had 1, 2, 3 trading sessions where the bonds were straight up, and nobody took that as a warning shot across the bow, right? You should, okay? Bonds up, and the market absolutely tanked. Now, another thing I wanted to display over here before we go any further is, well, the VVIX is up, the bonds were up, and the market tanked. Put us pretty much right back in what we term the hurt locker. We are pretty much on the cusp of that volatility box again, and I know it's sickening to have to mention this again. We are we north of it? Yes, right? But we're right there. We're on the edge once again of this volatility box. It's going to make all the difference. And the reason I actually put it in this weekend's update, the hurt locker, and when I was talking about this, all we were doing in here is just pinging back and forth. And we were pinging back and forth literally from early April, okay, until what? Well, just a few weeks ago when we actually broke out, early June. Nevertheless, we break out to the upside. So here we are, just as I said, north of kind of this hurt locker. My inclination moving forward, we may have a tough time getting under the 300 level, but if we do, things could get, again, wild to the downside. Obviously, you already see that, though, in terms of volatility in the bond market. However, this is an aspect that I haven't yet covered. If we get back inside of the range, okay, I would anticipate that if we come down fast and hard, we'll actually hit a floor. That floor might be somewhere around, we'll call it 275, okay? We'll hit a floor and rip back off of it. That would be before I think we would actually head down. So just be aware. Again, we're going to have some dicey trading days ahead of us, but we're very likely to start bouncing back around inside of the volatility box. All right, musical chairs. So that's a phrase that I've used a lot in the last couple of weeks. I call it market musical chairs, right? Well, the music stopped. Did you find a seat? That basically references, okay, are the sector rotations. We knew that the XLF, if the XLF took off to the upside, right, that it would cause the entire marketplace to rally. So we traded it for that, and we put on a back spread. Okay. We also knew that if the XLF got to the 2650, it would actually literally ignite the entire marketplace to the upside, and precisely that happened. But then we detailed, obviously, that if the XLF broke back below 2650, okay, that markets were going to get downright hideous. And that's pretty much where we stand right now. We are in some hideous territory, okay? Now, everything, okay? It's not about sector rotation here. It's just not. And that's when people are like, so we can talk about more about sector rotation? It's not going to be about sector rotation. Because on Wednesday night, we were talking about correlation. All right. And on Wednesday night's video, I said, if you open this marketplace and there's 90 stocks trading to the downside, I said, you're going to be in trouble. Now we're seeing correlation. So now what the market becomes, okay? Now what the market becomes is not so much a sector rotation game as the market is now going to be What sector do you want to be long? What sector do you want to be short? So in the very near term, I'll be real frank with you. I'm not going to carry too many long positions, if any long positions. I've got a couple little stocks, little, tidbits here, but I talked about earlier in the week. I blew out of a lot of different positions that were in energy. Okay. We actually got out of our energy positions. Specifically, we bailed out of XOP. Okay. Did we hit the absolute high? No. Okay. But it's a good thing we got out of XOP because that thing absolutely tanked. I'm not carrying too many long positions in here. All right. Bottom line. What I am looking at is that tech will be the epicenter of any big sell-off. The performance of the NASDAQ, okay, reeks of danger at this point. And I can only further reiterate that, right? All you have to do is look at some of the percentage gains and losses. Let me close up that right there. I want you to look with me here, okay, at percentage gainers and losers on the day, and it'll speak volumes. Look, see right here, that's the XLF. The XLF actually closed up 3% today. 3%. The S&Ps lagged. How's that possible? Because the monsters of tech, okay, had what? Very, very meager gains. In fact, Amazon happened to close down. Okay, Netflix isn't really one of our monsters of tech. All right, most of your big tech stocks lagged in today's trading session. Lagged what? They even lagged the S&Ps. It's already firing off warning shots that the NASDAQ could be in trouble. And when you think about this, you're like, why are you picking on the NASDAQ? It's because of the performance. And as I said, this would come up again. The weekly performance, right, of the XLF. Yes, the XLF could continue to go down. But the fact that it was down 11% on the week, okay, and that the NASDAQ at the exact same time was only down 2% on the week speaks volumes. Okay, we are not necessarily in a sector rotation game, okay, but we are in a marketplace that is absolutely unequivocally going to discriminate. It is going to go after specific sectors here to come off, and that's, well, what I'm going to discuss here momentarily. So the epicenter of any big sell-off is going to be big tech. The XLF and XLE already got decimated. The monsters of tech, keep your eyes on them. Monsters of tech, there are, once again, Microsoft, Apple, Facebook, Amazon, Google. Okay, consumer staples as well. Now, I brought this up also a moment ago. Did you take a look at like Walmart today? Okay, this is it. It broke to the downside. This has been an unscathed area of the marketplace. Right? By the way, I carry a bearish position inside of Walmart. I like to, just detail, like, listen, I'm carrying bearish positions in Walmart in multiple expirations. The other underlying that I'm also carrying bearish positions at that we're going to talk about next here is none other than Costco. Costco is just on the cusp of breaking to the downside. Again, both of them seeing fairly hideous percentage gains and losses in the last couple of days. Now, again, they held up. What you're feeling is relatively strong. But again, I think that the epicenter will, of course, be technology. Consumer staples, though, Walmart, Costco, are likely to actually get tagged. All right. Apple. Apple's my new Boeing. I have to explain a little bit about what that means. If the Dow is going to have issues, if the Dow is going to sell off, right, it's going to be done heavily on the back of Apple. Okay. If the Dow has issues, Apple has issues. Okay. Everything has changed inside of the Dow. Whether you know this or not, everything has changed inside of the Dow. Let me close up this left side bar for a second. The Dow is not market capitalization weighted. I'm going to say that again. The Dow is not market cap weighted. The Dow, okay, is all about the biggest monkey on the block. And right now, the biggest price stock on the block is Apple. Apple is, it looks exactly like Boeing did. And, I talked about the Boeing trade for literally for 2 years that eventually would pay out. And by the way, for those of you that do not know what I'm talking about in terms of the Boeing trade, okay, the Boeing trade, let me actually back up over a period of about 3 years. This is 3-year weekly, okay? Here's the bottom line. All right, I shorted Boeing all the way back here. I held a short position, not because I wanted to short Boeing, okay? Not because I wanted to short Boeing, but because, all right, we factored in that if the market ever sold off and the Dow ever sold off, that Boeing would get absolutely decimated. Boy, did we hit that one right on, okay? And it did. Well, now, Apple's the new Boeing. Why is Apple the new Boeing? Because if the Dow is going to come off, they have to crush Apple. Why do they have to crush Apple? because the biggest kid on the block. See, the only way to pull down the Dow, okay, on a point-by-point basis, the only way to pull down the Dow is to hit the biggest stock in the Dow because it's price weighted, which is a huge flaw. And right now, Apple, does it stand out? Oh, you better believe it. You better believe it. By the way, I'm short Apple and I am short Home Depot. Why am I short those two? Because they're the stocks actually I would believe is going to influence the Dow, okay, to an excess in the very near future. And these are stocks that I would look at. That's, again, it's one of the other reasons that I'm a little anti-tech right now. Again, monsters of tech, they're not going to be immune to the sell side activity. All right, a couple last aspects. You know, you heard me talk a lot about Lululemon. Well, Lulu actually finally, we see some sell-side activity inside of Lulu following their earnings announcements, but the stock was already selling off prior to the earnings with the rest of the marketplace. The earnings were absolutely terrible. Does it mean that Lulu is going to tank? No, but I'm a little bit less strangled by a pair of yoga pants at this point. So Lululemon, am I ahead of the game in here? Absolutely, unequivocally, no. I mean, I need Lulu legitimately at like the 200 level to really start to hit my stride in here. That's a very profitable trade. Down back to the 220, 230 region for me to actually break even in here. Come on, it's a hop, skip, and a jump away. But Lululemon finally headed in the right direction. Remember, it was just last weekend that we talked about like risk reward and in the entire marketplace and how this was going to be great. Last but not least, people, last parting words, keep your helmets on. All right, you're going to hit fairly strenuous degrees of volatility, and you need to be aware of it. And I cannot stress this enough. Okay, we're going to be back inside of gravity points here, 29.83. Okay, if you missed it, we actually cracked into the 29.83 today. Keep your gravity points on your screen, 29.11, 28.42. Hey, any rally at this point? I think we're going to look to fade it. With that, thanks everybody here for joining us at Theo Trade. Have a wonderful weekend. Bye-bye.